Okay, I want you to picture a sprawling global titan of a company. We're talking about an army of 800,000 employees working in sync across more than 120 countries. They pull in a literally massive $73 billion in annual revenue, and they boast a market cap sitting right around $110 billion. By any traditional metric, this is a modern industry behemoth, right? But here's the crazy part. Over the past year, its stock has mysteriously plummeted 27%. Welcome to this explainer. Today, we're diving deep to unpack this massive paradox, relying purely on the hard facts and data. Because, how does a company operating at this staggering scale suddenly lose over a quarter of its value, especially while the broader market is climbing? Well, let's find out.
So, the mystery company we're talking about? It's Accenture. Exactly 52 weeks ago, this giant was trading at a pretty lofty $291 per share. Today, it's sitting at just over $181. That is a shocking 38% drop from its absolute peak. So why exactly is the market treating this powerhouse like a melting ice cube? Well, the catalyst for the panic seems to trace back to June. Accenture narrowed its full-year revenue guidance. They basically shifted their expectations from a 3 to 5% growth rate down to 3 to 4%, and Wall Street just completely panicked. Investors assumed this tiny, slight miss was the very first sign that AI was finally breaking the consulting industry, and they figured the company was basically hitting a brick wall.
Which brings us to Section 1, Inside the Cash Machine, Defying the Drop.
Now, when the market panics, the best thing we can do as focused learners is just block out the noise and look directly at the actual hard evidence of their financial performance. Because honestly, assumptions about a business quote-unquote breaking are usually wrong when you actually peel back the curtain. So let's look closely at the balance sheet. Back in 2021, Accenture's revenue was $50.5 billion. Fast forward to the projections for 2026, and we're looking at $73.6 billion. That's a massive 45% revenue growth over just 5 years. Think about that for a second. The underlying business here is aggressively expanding, not shrinking. To add over $23 billion in top-line revenue in just half a decade, that takes an incredible amount of momentum for a company this size.
And if we zoom in on their amazingly strong recent Q3 fiscal 2026 results, that whole narrative of a failing company, it just starts to completely fall apart. Earnings per share came in at $3.80, which is up 9% year over year. Revenue was $18.72 billion, up 6%. But here's the metric that should really catch your eye. The levered free cash flow over the last 12 months is a staggering $12.6 billion. That means they have massive amounts of cash left over after paying all their bills and financial obligations. Toss in a return on equity of 24.4%, which is a really strong indicator of how efficiently they use their investment capital, and, well, these numbers just don't look like a business in decline. Literally, these look like the mechanics of an absolute cash printing machine.
Plus, for those of you who appreciate income, the current dividend yield is an incredibly attractive 3.6%. And here's a fun fact. Back in June, despite all that market panic we just talked about, they actually hiked their quarterly dividend by 10%, bumping it up to $1.63 per share. But the best part? It's backed by a super safe 47% payout ratio. That essentially means they're paying out less than half of their earnings as dividends to shareholders, giving them plenty of cushion. We're talking about an income stream that has grown at an average of over 15% per year for the last 3 years. That is huge.
And the sheer scale of the disconnect between the stock's price and its actual value is just fascinating. According to Guru Focus's proprietary valuation metric, this stock is currently sitting at 49% undervalued. No way, right? But their model puts Accenture's intrinsic value in nearly $358 per share compared to its current price way down in the 180s. Even if you look at more conservative, discounted cash flow models, many of them point to a fair value well above $300. So the underlying fundamentals, the profitability, and the financial strength, they remain incredibly robust, even while the stock price takes a total beating.
And to really hammer home this valuation mystery, let's look at the trailing price-to-earnings ratio. This is essentially the price tag of the stock compared to its current profits, and it's sitting at 14.5. That is near a 10-year low for this company. The forward PE, which measures the price against expected future earnings, is even lower at just 12.65. When you compare this to its software and consulting peers, it is significantly cheaper across the board. So we've got a growing business, a rising dividend, and a historically cheap valuation. Like I said, the mystery of this massive discount is only getting deeper.
All right, moving on to Section 2, a $9 billion strategy, the hidden master plan.
See, while the broader market is obsessing over slightly narrowed guidance, they are completely ignoring a massive catalyst. Accenture is not just sitting on its giant pile of cash, it is going on an absolute shopping spree. I mean, they have dramatically tripled their initial acquisition budget this year. They upped it from $3 billion to a staggering $9 billion. With that massive war chest, they are swallowing up 33 companies in 2026 alone. To put that into perspective for you, they only did 13 deals in the fourth quarter of fiscal 2025. This is the exact profile of a company aggressively investing in its future, not one that's retreating from the market.
Let's trace this rapid-fire timeline of late 2026 acquisitions together, because it's wild. On June 17th, they grabbed Industries Excellence to partner with Siemens. The very next day, they announced a massive $4.2 billion majority stake in the industrial cybersecurity firm Dragos, plus 2 other cyber firms on top of that. Then, in late August, they bought McCoy, a Dutch SAP transformation partner. And climaxing just today, August 27th, they announced the buyout of Comware over in Japan. They are aggressively, and I mean aggressively, building out a new unit called Accenture Edge, which specifically targets companies making between $300 million and $3 billion in revenue.
Now, you might be wondering, why build Accenture Edge? Well, because it perfectly positions them for what they've identified as a $240 billion mid-market opportunity. This M&A spree isn't just random, it's highly targeted. Pair this with a newly announced Google Cloud partnership to roll out AI solutions for mid-market companies, and throw in a massive €200 million contract with NATO to run their protected business network, and suddenly you start to see the vision. They are sprinting toward a mid-market AI and cybersecurity gold rush.
But let's look at Section 3, Risks and Red Flags, the bear case.
We have to be fair here. No investigation in this explainer would be complete without examining the objective reality of the risks. There are 4 main red flags holding the stock back right now. First up, insider selling. Over the past 12 months, insiders have sold $18.7 million worth of stock, and notably, there have been exactly 0 insider purchases. Yikes. Second, as we touched on earlier, they did narrow their full-year revenue guidance, which definitely signals slightly slower growth. Third is the absolute elephant in the room, AI consulting disruption. I mean, if artificial intelligence starts outright replacing human consultants, Accenture's core business model could take a really serious hit. And finally, integration risk. Successfully absorbing 33 different company cultures and tech stacks in a single year, that is incredibly difficult, and it poses a very real operational threat.
And these very real risks, they've created a deep divide on Wall Street. Out of 27 analysts, the consensus is still technically a buy with an average target of about $184. You have 11 analysts saying strong buy, 3 saying buy, but a very significant 13 saying hold. Firms like TD Cowen see it as a hold with a $173 target, citing worries about the downside. Meanwhile, UBS is highly bullish, seeing a massive upside with a $275 price target. The market is truly split down the middle on whether the AI revolution will destroy Accenture or completely empower it.
Which leads us to Section 4, the final verdict, solving the $110 billion mystery.
When bringing all the clues together here, the source analysis points to a strong buy. Why? Well, because it suggests the market has basically already priced in an absolute worst-case scenario for a highly profitable business. You are looking at a cash-generating machine that is literally paying you to wait while they execute a $9 billion strategic pivot, and $181 price point sitting next to a 14.5 PE ratio, a growing 3.6% dividend, and $12.6 billion in free cash flow. That paints a highly compelling picture of a company with deeply robust fundamentals, even when we fully weigh those very real threats of AI disruption.
So, I'll leave you with this final thought. When you weigh their aggressive $9 billion AI and mid-market gamble against the intense pessimism currently baked into the stock price, what do you see? Is this $110 billion cash machine a brilliant buy at these historical lows, or is the market actually right to treat it like a melting ice cube? Take the data we've explored today and formulate your own verdict. Thank you so much for joining me for this explainer. Be sure to check back for more deep dives where we let the data tell the real story. Keep learning, and I'll see you next time.